The following presentation is controversial and may challenge your way of thinking about investments. Proceed only if you are willing to have an open mind. We are Republic Capital Group, and our staff has over 20 years' experience in investment banking and stockbroking. While most people have been lucky if their investments have come out even since 2006, many of our clients have seen healthy double-digit returns in that time. We have accomplished this by using a unique investment strategy that contradicts traditional ideas about investing. Let's look back at 2006 and 2007. Back then, mainstream economists like Fed Chairman Ben Bernanke and Nobel laureate Paul Krugman stated that we did not have a housing bubble and that a recession was an unlikely possibility. They stated that, fundamentally, the economy was sound. Simultaneously, economists from a different economic philosophy, known as Austrian economics, predicted the collapse and laid out exactly how it was going to take place. These theories were laughed at by the so-called economic experts. After the housing collapse, these same experts stated that no one could have predicted what happened in 2008. Ironically, America continues to turn to these same experts to run the economy and give us advice. Doesn't it make more sense to follow the philosophies that were able to predict the crash rather than the philosophies that got us into the recession? Now, another crash is on the way, even larger than the 2008 housing collapse. Most Americans are at risk of seeing their retirement, their children's college funds, their very economic futures melt away. The wealth that most Americans think they have mostly exists on paper, and I will show you why that wealth is about to evaporate. Many people have a hard time accepting the conclusions that we reach. However, the facts that we are about to show you are undisputed and can easily be verified. The choice will be up to you whether to continue to follow traditional investment advice or whether to fill out a request for a free consultation with our company. The key to managing a successful portfolio is understanding risk. In a free market economy, the rate of return on an investment is related to its risk. A safe investment will yield a low rate of return, and a riskier investment will yield a higher rate of return to compensate the lender for the risks he or she is taking. However, our current economic marketplace is highly manipulated. Government regulations, subsidies, and artificially set interest rates all contribute to an environment where the rate of return you receive is often not related to the risks you are taking. Many times, investors are in a position where their investment carries a high risk but yields a low return. I am going to tell you about 3 types of risk that must be protected against to have the safest portfolio possible. The first type of risk is currency risk. If you're like most people, your investments are held in US dollars. Unfortunately, the US dollar is losing value. According to USA Today, in 2011, the U.S. government spent $5 trillion more than it collected in taxes. This means that it spent 3 times the money that it collected in revenues. The U.S. has been borrowing so much money that its credit rating has been downgraded by the S&P, and both Moody's and Fitch are calling the financial outlook for the U.S. negative. In April 2012, Egan-Jones downgraded its rating of the U.S. for the 2nd time. In the years to come, the dollar will decline even more rapidly than in the past. This has to happen. It is a mathematical certainty. Let me show you the facts. Total U.S. debt now exceeds the total U.S. annual gross domestic product. U.S. debt is so large that the U.S. government can't afford to pay a reasonable amount of interest on this debt. Even with bond rates at historic, near-zero rates, interest payments on the debt were equal to 20% of U.S. government revenues in 2011. If bond rates were to rise even 1%, this would cost the government an additional $150 billion a year. This amount is equivalent to the annual cost of the Iraq and Afghanistan wars combined. Because of this, the Federal Reserve has to keep U.S. bond rates unnaturally low. Right now, the U.S. is less able to pay its debt than any time since World War II. Normally, this would mean that bond rates would be high in order to attract buyers and compensate them for their risk. Yet, bond rates are being unnaturally kept at historic lows, and, as a result, many former purchasers of U.S. debt are no longer buying. In 2011, the Federal Reserve bought 61% of U.S. debt. In other words, in order to keep bond rates low, the Federal Reserve had to buy 2/3 of the U.S. debt because no one else would buy the debt at such a low price. The Federal Reserve had to cover this debt by creating money out of thin air. This is called monetizing the debt. As more money goes into circulation, the money in existence becomes less valuable, causing inflation. Right now, official CPI inflation is higher than bond return rates. This means that U.S. bonds are guaranteed to lose value over their term, even if inflation doesn't rise, which it is sure to do. As the Fed continues to create money to buy bonds, the dollar will continue to fall, making bonds that much less attractive. It is a downward spiral. We are already seeing this inflation happen. Based on the official government CPI, inflation was over 3% in 2011. At this rate, the dollar will lose 1/3 of its value in only 1 decade. More importantly, the government numbers may not tell the whole story. The government changed the way it figured inflation in the 80s, and then changed it again in the 90s. The government stated that the reason it changed the way it figured inflation was to come up with a lower number. If we figure inflation the same way it was figured in the 80s, inflation is currently over 9%. Any American that has had to pay for food, energy, education, or healthcare recently would probably agree that 9% feels like a more accurate number. You might hear mainstream economists say that the dollar is currently doing well. This is because they are comparing the dollar to other currencies like the euro or the yen. This is a flawed comparison because all the major countries of the world are devaluing their currencies simultaneously. By printing money to cover their debt, the developed countries of the world devalue their currencies and make their national debt less valuable. This is the only way these governments can manage their debt. This is why you will hear establishment economists say that a little inflation is good. Through history, whenever a country can no longer find lenders to cover its debts and has to cover those debts by printing money, that country's currency has become devalued. This is great for the government, but bad for investors. Those people that save and invest in dollar-based investments will lose purchasing power. That is what we call currency risk. Is your portfolio protected from currency risk? If not, you should fill out our form to get a free consultation. Let's talk about the second type of risk you should consider. The second type of risk is interest rate risk. This is closely related to currency risk. Are you earning more than 6% on your dollar-based portfolio? If not, your portfolio is likely losing purchasing power. The question you should ask yourself is, what is the real return on my investments? When looking at your portfolio statement, the number of dollars it shows may be increasing. However, as the dollar falls, the purchasing power of your portfolio may be shrinking. With energy, food, and healthcare costs rising 8 to 10% a year, has your portfolio been keeping up with the real cost of living? When interest rates are set by the market, they accurately reflect the level of risk involved. However, most interest rates, such as interest rates for savings accounts, CDs, and Treasury bonds, are based on arbitrary interest rates set by the Federal Reserve. Once you take risk factors and inflation into account, most investments yield a negative return. On this chart, the blue line shows the return in dollars of a 20-year Treasury bond. The red line shows the real return, if you assume an inflation rate consistent with official CPI inflation. After 20 years, the original $1,000 has shrunk to $928 in purchasing power. Here is another example. The blue line shows a stock portfolio with a return of 4%, which is almost twice the average S&P rate. After 20 years, this portfolio seems to have doubled in value. However, if you account for SGS inflation, which is inflation figured the way inflation was figured in the 1980s, then after 20 years, the original $1,000 has shrunk to $266 in purchasing power. When your investments do not keep up with inflation, that is what we call interest rate risk. Controlling for this is vital to having security and growth in your portfolio. To talk to one of our consultants about this, fill out our form for a free consultation after this presentation. The last risk type we will talk about is principal risk. This is the risk that is inherent in the investment, aside from currency risk and interest rate risk. One example of this is, how much control you have over your money. If you are investing your money directly into a CD or annuity or bond, you are once removed from your money. If you have a broker that invests your money for you, you are twice removed from your money. The farther you are from your money, the less control you have over risks that may be hurting your portfolio, such as fraud or mismanagement. Also, CDs, annuities, and bonds lock your money away for a set period of time and don't allow you to get at that money when you need it without a penalty. Now I've told you about the three types of risk. The numbers are real. The only way the U.S. government can deal with its debt is by devaluing its currency. It's a mathematical certainty, and it's only a matter of time. So let's talk about how to protect your portfolio from these types of risk. Using this strategy, it is possible to have a portfolio that has healthy double-digit annual returns, even when the markets are not performing well. Our strategy is diversification, but it has to be a special type of diversification. You have to diversify between asset classes that are not correlated with each other. Let me explain what I mean by the term correlated assets. Stocks, bonds, annuities, and CDs are all in the same category of assets. We call these assets correlated because they are all affected by the market in a similar way. These assets are all affected by the interest rates set by the Federal Reserve and by the health of the economy overall. Even real estate and peer-to-peer lending are correlated to the health of the overall economy. IRAs are also correlated when they are invested in these same types of assets. These traditional correlated assets are good because your money is being put to work for you. You are investing in businesses that are providing goods and services to society. You are loaning money to people who need it. By investing in these assets, you are providing the capital that America needs to build the economy. The problem with all these correlated investments is that they are all based in currencies that are being devalued by the government. If you have all of your assets in these types of investments, then your portfolio will suffer if interest rates change, if the market suffers a crash, or if the dollar loses value. Most Americans faced this problem during the housing crash of 2008. Their assets were connected to interest rates, the value of the dollar, and the performance of the market. According to the LA Times, the average American family has lost 40% of its wealth in this recession. The secret to achieving secure, long-term growth in your portfolio is investing a large portion of your portfolio into asset classes that are not correlated to the rest of your portfolio. One category of non-correlated assets is commodities such as food and precious metals. These assets are typically going to move in an opposite direction from column A. When the stock market falls, gold, silver, and food prices are typically going to climb. These assets also have the advantage that they can quickly be liquidated back into currency as needed. Another category of non-correlated assets are collectibles such as art and antiques, rare coins, currency, timepieces, and sports memorabilia. These items are not as liquid as the assets in column B. However, the prices for these items are not affected much by changes in the markets for the first two columns. Collectibles have held their value for thousands of years, in peace and in war, and represent a stable investment. However, in this category, it is particularly important to be able to select the right collectibles based on history, condition, and supply. Here is an example of 3 portfolios. In this example, each person invests $50,000, but each person gets very different results. Kevin invests his money equally into 5 of the top stocks in the market: GE, Johnson & Johnson, Merck, Citigroup, and AT&T. After 3.5 years, Kevin's portfolio has lost value. Steve also invests into the same 5 stocks as Kevin, except he puts 30% of his portfolio in a non-correlated asset class. Steve's portfolio does much better than Kevin's and sees a 20% gain over 3.5 years. Our third investor, Kate, also invests into the same 5 stocks that Steve and Kevin did, except she diversifies 30% among multiple non-correlated categories. Kate does the best by far, and her portfolio nearly doubles over 3.5 years. Let's look at a longer-term example. This example takes place over 17 years and spans the 2008 recession. Once again, each person invests $50,000. Just like before, Kevin invests his money equally into the same 5 top-tier stocks. Kevin sees good gains during the boom years of the late 90s, but loses much of his profits during the 2008 recession. Once again, Steve puts 30% into a non-correlated asset. Steve's portfolio doesn't do quite as well as Kevin's during the boom years, but once boom and bust years are averaged out, he comes out ahead of Kevin. In our third example, Kate once again puts 30% into 2 different classes of non-correlated assets. Kate's portfolio does the best during both boom and bust years, and after 17 years, her portfolio is worth more than Steve's and Kevin's put together. Both of these examples were based on real data from actual market transactions. Contact us for a consultation, and we will be happy to share the specific details of these examples with you. Now you've seen our presentation. The facts we've shown you are verifiable. They can't be disputed. Ask yourself, why hasn't your financial planner given you this information? The answer is simple. Most financial planners can only tell you about the investment opportunities offered by the financial institution they represent. All of the investments they offer you will be correlated. There is a place for those traditional investments. They can offer a return when the market is doing well. However, in order to build a complete portfolio that is properly diversified to protect you from risk, you will need to invest in multiple classes of non-correlated assets. If done correctly, investing in non-correlated asset classes will bring you growth, privacy, and security. Republic Capital Group has knowledge of these non-correlated assets and can often get you access to them at dealer rates. Do you want to continue to follow the advice of so-called experts that couldn't foresee the 2008 recession? What are you doing today to prepare your portfolio for tomorrow? The time to take action is now. Take the next step. Fill out our online form and get a free consultation to discuss what we have to offer you. We look forward to speaking with you.